Good afternoon and welcome to this online seminar. My name is Pierre Schlosser. I'm the scientific coordinator of the Florence School of Banking and Finance, and it's a real pleasure for me to introduce and moderate today's online seminar on stress testing in Europe, a primer. Today we'll deep dive into a crucial exercise in the assessment of the health of European financial institutions. Stress testing is indeed a key instrument for checking banks' resilience to an extreme but plausible adverse scenario. We have the chance of being in the company of two top experts in the field, so it's a real pleasure for me to welcome today Mario Quagliariello, Director of the Economic Analysis and Statistics Department at the European Banking Authority, and of Klaus Düllmann, who is head of the Single Supervisory Mechanism Risk Analysis Division at the European Central Bank. Mario, Klaus, thank you to both of you for being with us today. Many thanks also to my colleague Jan, who has prepared the seminar and is managing our online platform as we speak. To save some time, I will not give further details about our speakers' professional backgrounds. Our participants can have a look at our website where your short bios are available. Okay, so before telling you more about our audience, I would like to inform you about our school's upcoming activities, as I'm sure that some of you will be interested in these activities. You will know by now that the Florence School of Banking and Finance, FBF in short, is a non-national training platform which is part of the European University Institute. The EUI is a very distinctive place. It is a public, intergovernmental research and education institute which boasts an international community of more than 60 nationalities and offers doctoral and executive education programs in economics, law, political science, and history. A recent program of the European University Institute, the FBF, is a place where various generations meet to discuss and argue about cutting-edge topics of financial stability and macroprudential policies, risk management, as well as regulation, supervision, and resolution. Our school has a diversity of policy debate and training activities, meaning that our online seminars are only one of many activities that we run. We have a few policy debate activities in the pipeline, since we'll host the lecture in Florence with Elke König, chair of the Single Resolution Board, on the 22nd of March. The lecture, which will look at the journey towards resolvability, will be live streamed. On the 2nd of April, we'll have our next online seminar on decrypting sustainable finance with Professor Dirk Schoenmaker. And on 25 April, we'll host our annual conference on the European financial infrastructure in the face of new challenges. We'll also have a session at the European University Institute's annual conference called the State of the Union on the 3rd of May, also in Florence. On the training side of things, you can see on the slide that our school has been training more than 2,000 participants coming from 68 countries and a variety of organizational backgrounds since its creation. Over the next months, we'll be hosting several residential courses, including a course on non-performing exposures with Andrea Resti as a director, and a course on stress testing the financial sector precisely. The latter course is directed by Mario Quagliariello and Till Sherman from consultancy Oliver Wyman. It will also feature Klaus Düllmann, who is with us today, John Feld and Martin Scheicher from the European Central Bank. It will be held in Florence on 8 to 10 April. We have several other courses lined up until the summer on sovereign risk, on MiFID II, and on the economics of insurance markets, to name only a few. More details can be found on our website. Right, so it's time to thank you actually for your patience and to introduce you to one another. Since you don't see each other, let me do the presentations. You are around 120 participants connected today, following us from almost everywhere in Europe and from several other continents. 59 nationalities are represented, and we're very glad to count on several participants, as always, from the European Central Bank, the Single Resolution Board, and the European Commission, as well as this time participants from the National Bank of Romania and the Bank of Albania, to name only those two. Of course, let me welcome all the other participants from the organizations not listed here. 42% of you are women, 58% are men. In terms of backgrounds, you have also about 6.8 years of professional experience on average. This time, 63% of you are trained economists, 14% are lawyers, and 11% have a training in business. Lastly, 73% of you have a master's degree, while 20% of you have a PhD and 7% a bachelor degree. Right, so it's time to start. How will our seminar be organized? Well, Mario, our lead speaker, will guide us through the topic of today for about 20 minutes. Mario's talk will actually be supported by 3 polls, which will appear on your screen for you to fill in. And then Klaus will step in for about 7 minutes. Following Mario and Klaus' interventions, we'll open up the Q&A session where you guys will have a chance to write your questions or comments in the chat box that will appear in due course at the bottom of your screen. So let me stop here, disappear, and leave the floor to Mario in London.
So what I will do in the next 20 minutes is to give an introduction to stress testing and more particularly to the EU-wide stress test. So let me start with the objectives of stress testing. This is a pretty general summary of the possible objectives of stress testing. Clearly, there is a very general objective, which is assessing the stability of financial firms of the banking sector as a whole, which is probably the most important task for a stress testing. So it is basically an assessment tool for having an overview of what would happen to banks' balance sheet if there is an extreme but plausible event affecting the bank. But I would say over time, and depending on the specific conditions of a financial market, there are 2 specific objectives. In crisis times, the objective of the stress test is to support the crisis management and the resolution of the banks. So what is important there is to understand whether there are weak banks, if there are capital gaps, and to recapitalize the banks or to resolve the banks if there is no way of saving those institutions. And this is what happened in 2011 in the EU, in 2009 with the SCAP in the US. In normal times, when conditions are better and overall the banking sector is robust, the stress test is mostly a diagnostic tool for understanding whether there are potential vulnerabilities and which are the shocks that can trigger the vulnerabilities and create problems to banks. And this eventually can lead to ask more capital, but also to change business plans, to have additional actions which are not necessarily affecting the capital position of the banks. And I would say the main task eventually is to make decisions. So the stress test is not run just for the sake of it, but it is an instrument for the supervisors, for the macroprudential authorities, and for the banks themselves for making decisions. In terms of how the stress test works in the EU, we have a complex framework because, of course, we are running an exercise which is involving many banks, many authorities in different jurisdictions. And therefore, the different stakeholders have very specific roles in the EU stress test. Now, in terms of the role of the EBA, we have the task of initiating and coordinating the EU stress test in cooperation with the ESRB. And this also includes every year a decision on whether a stress test is needed or not. And indeed, what we started doing recently is to have a stress test every 2 years. Since the cycle is long and the information collected in a stress test is quite material and can be digested over time, we think that this kind of frequency works well for the banks and also for the supervisors. As part of our coordination role, we develop a common methodology which is applied EU-wide by all the banks in our sample. And I will be back on this point. Our methodology is for a bottom-up exercise, so to some extent it is for the banks themselves to assess the impact of the stress test, but still we create a methodological framework which ensures level playing field across banks. A very important role is for the competent authorities and for the SSM in the euro area, because they are the institutions in charge of assessing that the starting points provided by the banks are reliable. And you may recall that, for instance, in 2014, there was a comprehensive assessment in which before the stress test was run, there was an asset quality review on banks' balance sheet. The scenarios for the stress test are provided by the European Central Bank and the ESRB. The European Central Bank is providing the baseline scenario, while the ESRB is providing the adverse scenario. We also run a centralized FAQ process, Because clearly, even if we try to be as clear as possible in the methodology, there are always some doubts during the run of the stress test. Banks should be in a position to ask questions if they need to have clarifications, but we want this to be centralized, and all the banks should receive the same kind of supported information. This is why the FAQ process is centralized. And then there is another key role for the competent authorities and the SSM, which is the quality assurance process of the bank's results. So again, this is a bottom-up exercise. The stress test is company-run, but it is important for the competent authorities to assess the robustness of the assumptions used by the banks, if the quality of the data is sufficient, and overall the reliability of the results. Again, the final step is the publication of the results. Our stress test has been traditionally very transparent. We publish bank-by-bank results, but also the underlying exposures. It is very granular, and we try to provide a very user-friendly tool for navigating our results. And the last bit, which is eventually what I was referring to, mentioning the making decision part of the stress test, there is the follow-up action, which is for the competent authorities to decide whether there are countermeasures needed and some supervisory action needs to be taken for the banks performing weekly in the stress. Now, key characteristics of our stress test. I've mentioned already our stress test is a bottom-up, so it's company-run. Banks can use their own models for estimating the impact of the adverse scenario, of course, based on a methodology that we are providing. And I would say the key feature of our methodology is that we try to constrain to what banks can do and cannot do. So in a way, banks can run the stress test using their models, but there are some backstops. So if we realize that banks are too optimistic or that for any reasons their results are not reliable, some methodological constraints enter into the process, and we avoid that too optimistic results are eventually published. One of the key methodological aspect of our approach is the study balance sheet assumption, which basically means that we ask banks to freeze the balance sheet at the reference date, and nothing can change afterwards. And in addition, we don't allow banks to include in the results any managerial actions. So even if in real life, probably banks would deal with a adverse shock changing the structure of the balance sheet, this is not allowed in our stress test because we have this study balance sheet assumption, which is to some extent the device we have for ensuring level playing field across banks and comparability of the results. Our stress test since 2016 is no longer pass-fail, so we don't set any specific capital thresholds below which banks are failing the stress test, but it is instead an input for the supervisory review and evaluation process. So it's part of the regular supervisory process and assessment, and it is one of the inputs for supervisory decisions on the level of capital, and it is a key input for determining the amount of Pillar 2 guidance, which is a sort of supervisory expectations on the level of capital buffers banks should hold. For this reason, we also publish not a single metrics as the result of the stress test, but different indicators. Of course, the focus is very much on the CET1 ratio, which we publish transitional and fully loaded, but also on the leverage ratio, the level of provisions, and other indicators. In terms of the scenarios, we run the stress test according to two scenarios, the baseline and the adverse. So for the last stress test, we were covering the years between 2018 and 2020 because we have a 3 years time horizon. I would say this is quite a common practice to have 3 years. In terms of the number of the scenarios, we run 2 scenarios. There are other authorities, like in the US, running 3 different scenarios. But I think that this depends very much on the sort of setting and the needs of the specific Now, let's move to the first question for you. To some extent, the rationale of this question is that the bottom-up approach, so leaving to the banks the modeling of the shock, is sometimes criticized, since the banks can easily circumvent the methodology. So one question for the audience today is whether we should also move towards a more top-down stress test, and clearly there is a binary choice, yes or no. So I would leave the vote to you for a few seconds, and then we will check the results before starting the Q&A session. So for now, I'm not telling you, and I will not comment on the results. These will keep for the second part of the seminar. But let me move ahead and discuss a bit why we decided at some point to move from the pass-fail exercise, which we did run in 2011 and 2014, and move towards a non-pass-fail setting. Now, to some extent, this is very much linked to my initial distinction between stress tests in crisis times and in normal times. In crisis times, it was very important to understand capital needs, capital shortfalls, and asking banks to recapitalize. So this is why, for instance, in 2014, we set a pass-fail threshold at 5.5% of the CET1 ratio. All the banks below this level were supposed to raise capital to reach at least that level of capital. In 2016, the banking sector was much better capitalized. There were some weak banks, but it was not a widespread situation of crisis, so we decided to move to a non-pass-fail setting. Also, for avoiding that the pass-fail threshold is interpreted like once banks are passing our stress test, they are safe, because this is not the case. Our stress test is limited in scope, it is based on a single scenario, as I mentioned, which means there could be additional risks for some specific banks which are more idiosyncratic, so banks can still be in trouble even if they perform well in our stress test. And of course, removing this pass-fail idea was also helpful in terms of communicating that the outcome of the stress test is not the final say on banks' state of health. And also, I would say there is a more general issue, which is what resilience means for a bank. You can have some banks with a very strong capital position, but very sensitive to the adverse scenario. So they are resilient in terms of starting point, but they're also very sensitive. There are other banks perhaps with a weaker or lower starting point in terms of capital, but less sensitive to the shock. So I think both aspects should be considered, and moving from the pass-fail to the non-pass-fail helps in focusing more on the sensitivities and to understand better vulnerabilities and which are the areas for improvement, rather than just focusing on a specific bottom line figure, which is the final CET1 ratio. Let me move on the scope of our stress test, and I will try to be sort of relatively quick and then leading to questions if there are any. Our stress test is a solvency stress test. So what we look at is the capital position of the banks, and of course, this is also affected by the change and the dynamics of profitability in the adverse scenario. We don't cover liquidity risk, so it's not a liquidity stress test. While all the other risks affecting capital positions are covered. So certainly we have credit risk, in which I would say the main feature for last year's stress test was the introduction of the new accounting standards, IFRS 9, which of course changed significantly the way in which credit risk is modeled. We cover market risk, asking especially the most sophisticated banks to run a full revaluation of the balance sheet. We cover the cost of funding, so the impact of the shock on the net interest income. And here again, I think what is very important to underline is that since we don't have a liquidity stress test and we don't stress the volumes, the only element we stress is the pricing of funding. So the only impact is on prices, not on volumes. We assume that banks can have free access to funding even in the adverse scenario, but this implies that we are more conservative on this price effect. Since again, access to funding is ensured, banks should pay in a way more for getting access to this funding in the adverse scenario. We also cover operational risk and conduct risk, which is to some extent a sensitivity test on the top of the adverse scenario, because it's not directly linked to the adverse scenario. And also we have another area, which is all the other elements of banks' balance sheet. For instance, net fees and commissions is one of the key elements to be covered in the stress test. But then, of course, we also need to add a couple of aspects like taxation, transitional arrangements in regulation. And these are all covered in our methodology. Let me move quickly to give you a sort of idea of how the scenario for 2018 was looking like. I mean, the scenario is normally defined in terms of key macroeconomic variables. Here is just a very short selection, but actually we are providing banks with a quite long list of macroeconomic variables and financial variables as well. Clearly, the focus normally is on GDP, but as I mentioned, there are many other variables, and some of them are equally important for banks modeling decisions. And normally, the impact is expressed as a deviation from the baseline. Now, just for giving you the flavor, for 2018, we have a decline of GDP in the EU by 8.3% compared to the baseline in the 3 years of the stress test. But of course, we also had the stress in other advanced economies, in the emerging markets. We were also assessing the impact of that decline in the stock prices in commercial real estate and residential real estate, level of unemployment or level of inflation. So we try to be as comprehensive as possible, also for giving banks all the variables they need for modeling the impact of the scenario. In terms of the results, this is a very quick summary. As I mentioned, we published the results in terms of the transitional CET1 ratio and the fully loaded. I will focus in this presentation on the transitional, just for giving you an example. I think what is important to mention here is that clearly the transitional CET1 ratio is the key variable for supervisors, because this is the CET1 ratio according to the relevant legislation in each point in time of the stress test scenario. The fully loaded instead is more comparable, because all the possible national or bank-specific discretion and transition arrangements are removed. So the numbers we are publishing are very comparable. Anyway, just let me focus on the transitional for now. The starting point in terms of CET1 ratio was 14.5% at the reference date, so 2017, when we freeze bank's balance sheet. And the overall impact of the first time application of IFRS 9 was 10 basis points. So this is just the sort of restatement of balance sheet, moving from the old accounting standards to IFRS 9, which entered into force in 2018. Sorry. And then overall, the impact of the stress test is about 410 basis points, which brings to the CET1 ratio endpoint in 2020 to 10.3%. If you look at the distribution across banks, of course, there is a wide dispersion. The impact moves from as little as 30 basis point reduction in CET1 ratio to more than 700 basis points. This, of course, depends from different factors: the sensitivity of the banks, the severity of the scenario, which can be different across the jurisdictions, and we publish the different scenarios, so it is clear to everybody if some banks are more or less affected because of the sensitivity or because of the severity of the scenario in their jurisdiction. So it is very important to look at these numbers along with the scenario itself. And all this information that you can see here is not sort of supervisory confidential information, but is part of our disclosure effort. So this is all based on public information, which I think brings me nicely to the next question for you, which tries to test how much you know about our disclosure exercise and if you do use our data. So in this case, the question for you are if you have ever searched online for bank-by-bank results for the EU banks, and the core options for you are yes, very often, a couple of times, never, or you didn't know that this data was available online bank by bank. And as I mentioned, this is also one of the questions we will check at the end of the seminar before starting the Q&A. I think looking at the impact overall is interesting, but not very informative. This is one of my favorite charts in our in our stress test report, in which we try to provide the waterfall of impacts, which basically means understanding the different drivers of the impact. And you can see in red the reduction, I mean the drivers leading to a reduction of the CET1 ratio, and in green the profit, so what is actually still contributing to increase the CET1 ratio in that scenario. And I mean, not surprisingly, since European banks remain largely, especially in our sample, traditional banks, large part of the impact is coming from credit risk, so more than 400 basis points, and also the increase in the risk-weighted assets. Of course, in a way, the increase in the risk-weighted assets is sort of reflected in a reduction of the CET1 ratio, which is contributing to the reduction for about 160 basis points. Market risk is less material on average, even though it's quite important for some banks with large trading books, 110 basis points, and op risk is another 110 basis points. Still, banks have profits in the adverse scenario, and the green bar shows that overall the income is contributing in a positive way to CET1 ratio by almost 400 basis points. Of course, this contribution is lower than would have been without the shock, but still it is important to show that banks still can make profit in the adverse scenario. Now, I'm moving to the end of my quick introduction. What we have learned in 2018. I mean, overall, it was a severe exercise. I think the scenario was, in terms of deviation from the baseline, the most severe in the sort of history of the European stress test. And in addition, with the implementation of IFRS 9, the overall depletion of capital was, I think, also the highest for our banks. The good news is that banks, on average, were resilient to the shock, partly thanks to the initial capital provision and also thanks to the lower sensitivity because of the improvement in credit quality. Still, I think if you look at the bank-by-bank results, you will see very easily that those banks performing not well in the stress test are also those with challenges in terms of profitability. So if you recall the waterfall of the drivers, you will see that for many banks performing badly in the stress test, the green histogram on the profit contribution basically is almost close to zero. So there is no recovery in profits, which is big contributors to the cross-bank heterogeneity of the results. The results are very much bank dependent, so it's very, very difficult to understand and find a common trend for given geographies, which I think is positive because this shows that our methodology tends to be neutral. So it's not more penalizing for some countries and less for others. And there are good and bad performers in each country. And the last point is what I mentioned already at the beginning, that of course we don't cover all the possible risks and we don't cover all the possible scenarios. So it is important to understand these results in the specific context, not to infer too wide sort of conclusions on banks' state of health. This is also the reason why we are so keen to publish bank-by-bank information and granular exposure, so that people, analysts, market participants can run their own additional sensitivities if they want. And as I mentioned already, the stress test is not the end point, but is the starting point. So the competent authorities are now using these results for checking whether banks can be subject to additional risks or can have in place good mitigating actions for reducing the impact of the stress test. And this eventually leads to the decision on the proper level of Pillar 2 guidance. Let me conclude on the way forward. Every time we finish a stress test, we have a lessons learned exercise, which we are currently running, and we get feedback from the banks and from the competent authorities. And what we got this year, which is also to some extent our assessment, is that this is a useful exercise, but it's very complex. It is resource intensive for the competent authorities, for the banks, and for the EBA as well. It is informative, but some of the constraints we have in the methodology are perceived sometimes as not too realistic. And this, of course, can reduce the usefulness for the banks and for the authorities. And in some cases, banks are claiming that our constraints are calibrated in such a way that they become binding most of the time. So de facto transforming a bottom-up exercise into a top-down. Now, again, I'm not necessarily buying all these arguments, but I think there are some parts of these criticisms which we should assess and consider in our rethinking of the stress test. And also the study balance sheet, as I mentioned, requires additional efforts after the publication of the results, because there is then a dialogue between the authorities and the banks for understanding which kind of mitigating actions are realistic and can be included in the final outcome of the stress test. And the other point, which is often criticized, is that the supervisory decision is not disclosed. So even if we publish very granular results, for the analysts and market participants, there is a sort of opaqueness at the end of the process because the final supervisory decision is not disclosed. Of course, there is no decision yet on what to do next. I think for 2020, you can expect a stress test which will look very much like the 2018, of course, with some methodological improvements. But for the future, we are discussing whether we should have some fundamental changes. And this is part of the ongoing discussion with the industry and, of course, with our members. Which brings me to the last question for you, which is your way of helping us in shaping the new stress test. And this is a specific focus on the internal models and on our constraints. So the question is whether banks should be left free to use internal models without constraints. Option 1 is yes, so this would make the exercise more realistic. 2 is no, this would make the exercise less credible and conservative. And number 3 is that you have no clue about the constraints. Hopefully now you should have at least a clue at the end of my speech. And I think this is it from my side.
Okay, thanks a lot. Thanks a lot for that, Mario. We'll just give a few more seconds to people maybe to fill in the poll and give a chance to Klaus to prepare himself and appear on screen. So Klaus, you should also unmute your mic. That's what you did. Great. And then connect your camera and share it. Perfect. Here you are.
Okay, thanks a lot. And good afternoon from Frankfurt to everybody. I wish you enjoy as much sunshine and blue sky as we are currently enjoying here, but you obviously cannot see it on the screen. Please let me to introduce you first to the relation of the ECB, the European Central Bank's role in stress testing with the EU-wide exercise and the EBA that Mario talked about in the last 20 minutes. As you see on the screen, there are, for us in the SSM, in the single supervisory mechanism, basically not one, but two supervisory stress test exercises that we performed for significant institutions in 2018. Significant institutions means these are those institutions which are under direct supervision of the ECB, which differ from the less significant institutions which are only under indirect supervision and direct supervision by what we call the national competent authorities. Now, what are these two exercises I talked about? On the left-hand side, you see the EU-wide EBA stress test, as we call it. And here in this stress test, which is essentially the stress test Mario talked about, we have 33 of our significant institutions that participated in this exercise. And the results of this exercise are publicly disclosed bank by bank. And the coordinator of this exercise is the EBA, of course, in coordination with other bodies that are mentioned here. We distinguish this from what we call the SSM stress test, and for given the broad audience and heterogeneity, maybe I should explain what this acronym SREP means. As you know, supervisors regularly assess and measure the risk for each bank, and the SREP is a core activity which stands for Supervisor Review and Evaluation Process. It summarizes all the supervisor's findings of a given year and gives the bank, let's say, homework to do. Specifically, the SREP shows where a bank stands in terms of capital requirements and the way it deals with its risks. And in the SREP decision, which the supervisor sends to the bank at the end of a process, key objectives are set to address the identified issues which then the bank has to correct. So in a nutshell, this really constitutes a core supervisory activities, and the stress test results factor into this one at important stages, but exactly how this is done is something that I don't have the time to talk here about, but we'll go a bit deeper in the seminar in Florence soon. So what are in this SSM stress test, we have 54 institutions which are participating, so even more than in the EU-wide exercise. This is an exercise that is fully under the ECB SSM coordination, and the results are publicly disclosed only on an aggregate basis, i.e. contrary to the European-wide exercise, not bank by bank. The methodology that we use, though, is the EBA methodology. The objective that we have in the exercises is, of course, to assess the resilience of financial institutions, to contribute to the overall supervisory review and evaluation process, the SREP, and the quality assurance, as Mario already mentioned, where the competent authorities are involved. Here, the purpose is to have a consistent treatment of the participating institutions, which means we aim at a credible and fair outcome, comparable results at the end, also to have comparability and a fair treatment in the SREP. Now, let me move to the next slide. Sorry, I was too quick. Coming now exactly more to the roles, the EBA on the left-hand side. Here, the role is initiation and coordination of the EU-wide stress test. It's leading the development of the methodology, also responsible for the application of the final results in the EU-wide stress test. We have then the ECB in the middle. We are responsible for the coordination of the SREP stress test. It is the second exercise that I have mentioned. We are doing the quality assurance for the EBA and the SREP stress test for both exercises, and we are also responsible for the direct interactions with the banks. And the banks were also a key stakeholder. Obviously, they have to deliver the data, and not only historical data but also projections, and also provide explanatory information to explain how the results came into being. So the quality assurance, which is a key role for us, has the main objective to ensure a level playing field among institutions. The exercise itself usually has three phases. We have a first phase where the banks have been given all the information they need, the scenarios, the methodology, the templates, and then they have to fill out the templates and come up with historical data and projections. And in last year, in 2018, they had, let's say, more time for this than before because of the introduction of IFRS 9. Supervisors felt this would be justified. So from beginning of February until end of May, this was what we call a bank-led stress test. And then end of May, they submitted the first templates. And from this, we began what we call the quality assurance phase, which is, in our case, for the ECB, consists of 3 cycles. This was from May until October. And then October to 2nd November, the last weeks were what we call the finalization of the stress test results. That means, as you can imagine, there is a pretty long approval process for the final results. Many stakeholders are involved within the ECB and the SSM, but also, of course, in the EBA. And then you have to prepare finally the publication itself, the publication template, the EBA writes the report. So the last weeks are more the finalization stage. Now, on the outcome, let me show you here the overall results for the banks in the SSM, and the total results you see in a box plot on the right hand side. Then we distinguish between the EBA and what we call the SREP banks, i.e. depending on which exercise you are participating, and you see quite a, let's say, diversity of outcomes. And obviously for the SREP banks, the diversity is even higher than for the EBA banks. So what the main task of the quality assurance is, in order to achieve in the end a comparable and fair outcome, is really to look at the differences and where they are coming from. So we need to understand what is driving it. So in essence, do these differences reflect the true risk profile of the banks, or are there other causes? For instance, the bank did not correctly implement or did not understand the methodology correctly, and this is the task that we address in the quality assurance. So basically, if you take the very first submission of the banks in May, then this distribution would have looked like a little bit different, and then it changes when banks have to resubmit, and what you see here is basically the distribution that we had at the very end of the exercises, when we were as supervisors agreed that the results are comparable and also credible to finalize the exercise. The last slide you see, you see a short comparison with other exercises. We are obviously not alone in the world doing stress tests. We have stress tests which are dedicated outside the EU-wide stress tests, also in the UK, a national stress test. And then obviously also in the US we have a stress test. We have the IMF who is doing stress tests within their EFSA program. So basically what you see here is the outcome compared to the other exercises, and you see broadly that's very similar. Let me explain for those of you who are not so deep in stress testing, explain a bit the measure that we use, which is the capital depletion. And this capital depletion is also the measure that we basically used in the previous slide in the box plots. So the capital depletion is basically the reduction you see in the core equity tier 1 ratio between the beginning of the stress test and, let's say, what is the bank's projection in adverse scenario 3 years later at the end of the stress test horizon. And we use this CET1 ratio, or the change in percentage points of the CET1 ratio, as a common reference. And to explain this component, the common equity tier 1 is basically the component of the tier 1 capital that consists mainly of common stock held by the bank. And you divide this common equity tier 1 by the risk-weighted assets. And the risk-weighted assets is basically the bank's assets or off-balance sheet exposures weighted according to risk, and this provides an easy approach to compare banks across different geographies, and off-balance sheet exposures can be easily included in capital adequacy calculations. So this ratio we look at the beginning of the stress test, and then 3 years later at the end of the horizon, and the difference, this is what we call the capital depletion, and this is what you see here and also on the box plots before. And more about this, how this interrelates and how the results came into being, I would leave for the seminar soon, and looking forward to meet you if you join this. Thanks a lot.
Thank you very much. Thank you, Mario and Klaus, for these very informative presentations. So I'm sure that it will have triggered a few interventions from our participants. Before to give our participants a chance to write their questions, let me specify first that the slides will also be made available on our website shortly. We'll invite you also to share not only questions but also remarks if you wish. As always, if we have too many contributions, I will regroup them. And if there are any questions coming up on the content of your residential course here in Florence in April, I suggest that we address them at the very end of the Q&A session. So perhaps as a starter, I could invite both Mario and Klaus to have a look at the results and interpret the results of the 3 polls. I don't think it needs only to be Mario. It can be, of course, Mario and Klaus interactively. Just, you know, thinking loud about the results and sharing your reaction.
Well, perhaps I can start. I think it's very interesting and to some extent very useful for us. I suspect the results are also reflecting the composition of the audience. Probably there are not many banks there. But let me start. The first one was on whether we should move to a top-down approach, and I think 66% are saying yes, which I think is interesting. To some extent, probably we should have said that there is already top-down modeling available in Europe. The ECB and other colleagues are using their own top-down models as part of the quality assurance, as Klaus was mentioning. So it's not that there is no top-down. The issue here is whether we should move towards a US system in which top-down results are the key driver of the supervisory decisions. I think more EBA oriented is the level of awareness of the disclosure exercise. I think not too bad. 60% of the audience is using our website for downloading or checking data. But there is 40% of participants saying they have never done or they didn't even know that this was available. I think on this, the invitation is go to our website. It is quite rich. It's very user-friendly. You can get interactive tools mapping tools, but also the entire database, which can be interesting for the academics online. And we try to support the users if there is a need. I think for me, the most interesting part is whether we should remove or relax the constraints in our methodology. Very good news for Klaus and myself is that only 4% of the participants don't have a clue of the methodology and the constraints. And 71% are claiming that we shouldn't remove constraints because they ensure conservatism and level playing field, which I think is interesting also for our internal brainstorming. I suspect, as I mentioned, the participants are a bit more on the conservative side than the average banks participating in the exercise, but I think it is a useful feedback for us. I don't know, Klaus, what you think?
Yes, I would agree that this is also very interesting results, and sometimes also it makes sense to listen also to colleagues who are not so deeply involved in the stress test and have a more also external reflection, because then sometimes you spot also aspects that you are a little bit too focused in the exercise and may not spot immediately. So I think this is really helpful. What surprised me a little bit was this very strong support for a more top-down exercise. And here my suspicion a little bit is that maybe there's not a full understanding in terms of what this means also in terms of comparability, because I understand that also from the next questions that maybe this support comes from the fact that if you have a top-down exercise, it's more consistent. And we in the EU try to tackle it from a different angle by having a very constrained methodology, which is different from the US. US have also, let's say, a bottom-up component, but without this methodological constraints. And then, of course, we have this huge effort in the quality assurance, where we go rather deeply in the results and try to quality assure them. So it will be very interesting to have also a follow-up discussion, also I guess with participants in the seminar on this question, when everybody has a more fuller overview also what exactly we are doing. If they would still answer the question in the same way, and maybe they do, and that would be really a very interesting confirmation.
Thank you so much. So I think there are two questions which can be integrated in one. David's and Sebastian's, who are both comparative questions in a way. They're asking about the performance and the granularity of data basically compared to other jurisdictions. If you could address this, Mario or Klaus? So
I think
David is asking, how does the EBA calibrate the appropriate level of stress test in the adverse scenarios? It seems a little less severe than the Fed CCR. And then Sebastian is asking, why does EBA publish annual data? PRA and Fed publish quarterly data.
Okay, so let me start. I think on the scenario, probably Klaus can help me. I would say, okay, first of all, comparing scenarios across jurisdiction is not an easy exercise, because we need to check different variables. I mean, clearly, if you, for instance, compare the impact in terms of GDP in the US and the EU, you are looking at the US GDP and the EU GDP. So clearly, there are two different concepts there. The specific stage of the cycle is different, so there are many elements. But let's say that we assume that we can compare macro variables across jurisdiction. What we have seen is that probably when I was discussing about the scenario, in the US they have two scenarios, the scenario which they call the adverse scenario and the severely adverse scenario. What we have seen is that on average over the years, our scenario, which is a single adverse scenario, sits somehow between the adverse and the severely adverse. And last year was closer to the severely adverse. So I would say this is part of the sort of our setting in which we have one single scenario, which is, if you want, to some extent, average impact between the US and the EU. But again, the severity of the stress test shouldn't be looked only in terms of the GDP impact, but also in terms of the whole set of variables and also the severity of the methodology. As I mentioned, we have a bottom-up with significant constraints. Some constraints are very conservative, so this is the way of looking at the overall severity. On the publication of the data, now, we publish annual data as part of the stress test, but because the impact is assessed year by year, I think it would be very complicated to ask banks to assess the impact of the stress test quarter by quarter, and I'm not sure it would be informative anyway for the supervisors. It would be a big burden for very little benefit. In terms of publication of the sort of real actual data, we do publish quarterly data in our risk dashboard, even if it is aggregated by country. And as part of our annual transparency exercise, we publish bank by bank data for a much larger sample of banks on a semi-annual basis. So we are trying to move in the direction of being as transparent as possible on bank data, of course, with some regulatory constraints in Europe.
Well, if I may complement with two aspects. On the one hand, regarding the scenario, obviously this is a process that is quite complex. I mean, we involve here various stakeholders. Economists are very much involved using their models in order to do their best to achieve a consistent scenario, as we call it, which is, of course, let's say, also informed by what supervisors perceive and what are the main risks for the banking system at this stage. But then to transform this into exact projections is, of course, then quite a challenge, in particular if you have so many countries. And it's not only for the Euro area where we need projections, and not even the EU. We need projections also for the rest of the world, because we have also banks who have exposures in particular parts of the world, which are for some banks quite material. So this is really a challenge, and I think we are doing a lot in order to do that. In order to look at also the comparative of results, I would also like to mention, if you compare it with the US, of course the results are, let's say, less severe than what is in the severely adverse scenario in the US, but we are a little bit more severe than what is in the adverse scenario of the US. So we are a little bit in between. And as Mario said, it is not only sufficient, I guess, to look at the scenario itself, because the methodology plays also a huge role in order to determine what is the final outcome. Let me give you an example. What we imply here in Europe, and that is something that is not reflected in other countries like the US, is this what is called the static balance sheet assumption, which means essentially that you freeze the balance sheet, and it's not possible, for instance, by assuming a growth in certain business lines over the stress test horizon, also to create, let's say, a higher income stream coming simply from a certain growth in business that you project, and we are basically cutting it by freezing the balance sheet. So that also adds to this. So it is, if you want to really to compare the numbers, you have to...
So this fits perfectly into the question by Jorge, who is asking, is there a plan for EBA ECB to move to a dynamic balance sheet approach for stress testing? And in that case, what methodology would you consider?
This is a very good question. I would say, well, probably there is not a plan. Clearly, this is part of the discussion on the way forward. And I think some of you may have seen the speech of the former EBA chairperson and now SSM chairperson on what could be improved or at least should be discussed as a way forward for the stress test. Now, again, it's not a plan, it's part of the brainstorming, would be a big change in the methodology, so it's something we need to reflect on. And to some extent, of course, would guarantee that the results are closer to what banks are doing, but would be more difficult to assess in terms of comparability and level playing field. I think how this can be done is also quite diverse depending on how far we want to go. I mean, we are already discussing for 2020 the possibility of being a bit more flexible when we have constraints based on historical data, whether we can allow to use pro forma data if there is, for instance, if there are, for instance, big mergers, acquisitions affecting bank's balance sheet. Then, and this in a way is not really a dynamic approach, but is to some extent softening the constraints we currently have. Of course, then you can move further in the direction of allowing some mitigating actions, and this is in purely theoretical terms. You can have you can allow mitigating actions already happened after the reference date, but before the close day of the stress test. Or you can even include all hypothetical mitigating actions. Of course, the more you move towards freedom for the banks, the more difficult Klaus' job is in terms of quality assurance, and less easy for us to guarantee that what we are publishing is reliable. So clearly there is a trade-off, and finding the right balance is our challenge for the next probably few years.
Well, I would like to add only, let's say, a very personal view, and that is, if the exercise going forward stays more or less as it currently is, then this is a question that we have discussed quite a lot of times, as Mario knows, for a couple of years, and we are again and again challenging us there, and I would say we would not come to a different conclusion, i.e. stay with a static balance sheet. Of course, if you cast the net a little bit wider and think about changes to the stress tests which are quite substantial, then I could also think that there are variants where a dynamic balance sheet would make sense, but then, as I said, I would think we are talking quite different stress tests than we are talking now.
Okay.
But this is the personal
So, formally we're at the end of the duration of this seminar, but I wanted to ask Mario and Klaus if you had 5 or 10 minutes more so that we can tackle a few of the remaining questions.
I think for me it's fine. Yes.
Okay.
Yes.
Let's do that. So what I'll do is that I'll select 2, and then I will give you the choice to pick up also 1 or 2 at your convenience. So one question which I think is straight to the point is about liquidity risk, which you had mentioned, Mario, I think at the start. Maddalena is asking, do you plan to develop a stress test methodology to capture liquidity risk?
Okay, probably I would leave this to Klaus, since they are doing it.
yeah, thank you.
It will come back at some point, I think.
Well, as you may or may not know, we are running here for the SSM this year, where we do not have an EU-wide stress test, exactly a liquidity stress test. And so we have a methodology there which we are now using for the very first time. It was developed exactly for the stress test. Why do we do it separately from the EBA stress test? I think the content argument is basically that the EBA stress test is at the end targeting the solvency position by the banks under adverse circumstances, which we also is reflected in the use of the capital ratio and the depletion, the change of capital ratio over the stress test horizon. If you look at liquidity, then basically the main question is, can banks meet the cash outflows with the cash inflows? So it's basically a question of cash flows and what is the horizon over which you expect the bank to be able to meet this, and when basically the liquidity buffer is maybe exhausted. So it's a different measure, and that makes it, let's say, quite challenging, and would even make a quite detailed and already complex methodology much more detailed and complex if you would add this to the EBA stress test. So I think this is a content argument why we do this separately, and try to, let's say, gain first knowledge on this aspect in this year's stress test, which we run only for banks.
Perhaps the only thing I would add is that also, in a way, recalling what Klaus mentioned before on the dynamic balance sheet, I think integrating the solvency stress test and the liquidity stress test requires a different kind of stress test compared to what we do. We have the study balance sheet assumption, which doesn't make sense for liquidity, and to some extent, which I think is more subject to discussion, we are very transparent in the publication of the results bank by bank, which doesn't necessarily work well for liquidity risk as it does for solvency stress testing.
Okay, thanks. There were two questions on sovereign risk. So one is saying, do scenarios cover sovereign risk in a comprehensive way? And then the other question by Foteni Sofia is more related to the Greek banks case. And so the question is whether the exposure should be captured by the stress test methodology. I don't know if you can reflect and comment on that.
Well, perhaps I will take the one on the sovereign because the Greek banks were not in our sample. Now, yes, I mean in the scenario we have as part of the financial variables dynamics the evolution of the sovereign spreads by country, including for last year the widening of sovereign spreads, especially in some jurisdictions. So in a way, it is covered in the scenario and it is covered in the methodology. So what we expect banks to do in their bottom-up exercise is to assess the impact of the sovereign spread widening in terms of credit risk, provisions, and the evolution of risk-weighted assets, market risk, which probably is sort of more material, and also the impact on the net interest income. So it is covered comprehensively in the methodology.
Okay, Klaus?
Yeah. To add on the Greek banks, maybe this question comes also from one of the slides that I had where we put the 4 Greek banks in 2018 in the column for the EBA stress test, and this and so I'm also very thankful for the question because it allows me to clarify something. These banks were, let's say, not officially part of the EBA stress test, but we put them there in this column because we wanted to make clear that the stress test that was run for these banks by the ECB was fully in line, and the methodology was exactly the same methodology as was applied in the EBA stress test. The reason why they are here separated out a bit is basically that in Greece there was a program ending, so we had a certain requirement to run this stress test earlier because they need to finish earlier. And given the whole discussion that we had about the introduction of IFRS 9, of course we saw no way to run the whole stress test under this very tight and constrained timeline. So the solution was basically to, let's say, front run the EU-wide exercise by having a separate stress test for the 4 Greek banks. But as I said, we would like to emphasize that the stress test was run exactly with the same methodology as the EBA exercise, and the results are also publicly available.
Okay, thanks, sir. I think there was another question of clarification by Laura saying about the slide 5. I don't know if it was connected to what you just said, where she's asking there were some banks with a positive capital depletion of 1%. How can this be explained? And then I'll let you pick up a question each.
Yes, this is indeed the case. I can confirm this. This was for a SREP bank, and this basically reflects, without knowing now exactly which banks it was, of course, but I can give a general answer. And that is that the EBA stress test, of course, focuses on, let's say, a generic business model, basically as we usually see it. But in the SREP, we have, of course, also in this exercise banks which have very specific business models, and the EBA methodology may or may not stress them in the same order of magnitude and with the same severity. So it can, usually we had indeed some banks where we had a positive outcome because of this business model where the usual main drivers, in particular credit risk and then also interest rate risk, were not material. Custodian banks, I think, are a typical example. And then, of course, you come up with a stress test outcome which is, let's say, a little bit different from the rest, which is also one reason why we are not publishing this bank by bank, because we do not have a scenario which is really business model specific. We use a common scenario, which is from macroprudential perspective, I think also the right way to go, but it has its limitations when it comes to very specific business models.
Thanks a lot. So perhaps over to Mario. I don't know if Mario, you had a chance to screen the questions and answer one that you picked, and then I'll ask the same to Klaus.
It looks to me that we sort of covered most of them. I think there was one which I think is interesting because it was something we were discussing with Klaus, I think last week, if I'm not wrong, which was Klaus showed the results of the SHREP banks and the sort of EU banks, and there were some differences. And also there were a similar question on the, again, euro area, if there is a breakdown in our data between the euro area impact and the non-euro area impact. Now, what I would say is that clearly, since we publish bank-by-bank results, it's very easy for everybody to check the two impacts. If I remember well, we have in our report one chart showing the sort of country-by-country impacts, and for the SSM, we don't publish the country-by-country, but only the SSM, because it is a single jurisdiction, and is also the way we select sample of banks. And if you look at the figures, they are quite similar. I mean, there are some differences, but overall the impact is comparable in magnitude. There is instead a difference, I don't think is too material, but it's not negligible between the SHREP sample and our sample. But I think based on the sort of country coverage, is clearly this is depending on the composition of the sample. So in a way, it is idiosyncratic, meaning that it depends on the countries that we have in our sample.
Okay. Klaus?
Nothing to add from my side.
Sure, of course. Yeah, we're at 2:10. So okay, we will close it here. I think we addressed most of the questions. I'd like to warmly thank our participants first, but also you, Klaus and Mario, our speakers, for your time and dedication. Our next online seminar will be, as I mentioned, on the 2nd of April on decrypting sustainable finance with Dirk Schoenmaker. So stay tuned, and I wish you simply a very good afternoon to everyone.